button and I hope that it records the right thing. Alrighty. So thanks for coming along today. For those of you who don't know me, I am Shelley, Director of CMAA Accounting and Advisory. We are a boutique accounting firm based out of Omakura, but covering most of the Bay of Plenty and the Western Bay of Plenty, and further afield, but locally as well. So I will click through. So once again, thanks for taking the time to come in and listen to the webinar today. Just briefly, part of one of our core values at ClearMind is empowerment, and that's around educating our clients to have the skills and knowledge that they need to run their businesses efficiently and effectively as they can. So it's not just about telling you what to do, it's giving you the background of why we do it as well. So nobody really likes being told what to do unless they've been told why they're doing it. So it always goes over well. So before I start, I'll just share a thought for the session. So the budget is not just a collection of numbers, but an expression of our values and aspirations. So I guess your budget expresses your aspirations for the business over the next 12 months. It's just the next step of that is making sure you can understand, monitor, measure what you've set in those budgets and forecasts. So there's not much point setting them and forgetting about them. They lose their value a lot then. So I guess this webinar is mainly about demystifying some of those reports that you'll get weekly, monthly, quarterly, annually, whatever. Ideally monthly or 2 monthly, you'd be looking at your numbers to see where they are, but I know most people don't. So this is just going to hopefully give you some tools to be able to do that. So over the next 45, 60 minutes, we'll cover the importance of knowing your numbers, an overview of the different reports that you can produce and that you will see, the difference between profit and cash, the key drivers of business value, how to protect your assets, and how to adopt best practice. And then we can have a look at some potential next steps for you to take to make sure you really do understand your numbers. You should have received a copy of the workbook, hopefully, a little while ago. Didn't want to send that out too soon, give you too much chance to look at it. So, yeah, if you can have that handy, that'd be good. Ideally, you can take some notes as we go through. And if you've got any questions, some of it is probably a bit of a foreign language for people that are relatively new to business, or even people that have been in business for a long time, to be honest. It's, completely new words and things that you may never have heard before. So send your questions in at the end. Send your questions in as we go in the chat, and I'll go through them at the end. So cool. Moving on. So knowing your numbers is so important in your business. It allows you to interpret your reports and know if you're on track to achieve the goals you've set. So here are the my top six reasons why you need to know your numbers. So they tell the story of your business. Accounting really kind of is the language of business. So to understand some of the key accounting terms will really help you understand your business and be able to identify things quicker. Obviously, and it helps you interpret those results. Helps you identify symptoms versus the root causes. So, for example, a decline in your gross profit is a symptom, but there may be many root causes of that, such as ineffective pricing, rework, poor purchasing, wastage, etc. Knowing your numbers will enable you to spot an early warning sign of a potential issue. So that's why we don't like to just wait till the end of the year and look at the numbers. Ideally, you are looking at them regularly so you can identify those issues early on. So, for example, it might be monitoring how long it takes for customers to pay you. And if that number starts to increase, it's responding to that, putting processes in place to reverse that. It identifies the areas of strengths and weaknesses in your business. For example, your balance sheet indicates whether your business value is going up or down. So keeping an eye on those things is important. Understanding your numbers also means you have reliable financial information to base your decisions on. That helps you build up that confidence to make those decisions, knowing that the results are there. And finally, knowledge is power. Obviously, we know that across all industries, across everything. The more you know about your business, the better your business will be. So it's kind of the key things that make it so important. And generally, no one's ever thought what you go into business for. You've got no idea what a profit and loss means, what a balance sheet means, what a trading account is, what's gross profit, all those things. They're all just foreign words when you start up in business, because you're in business to do the thing that you love. And this just kind of comes with it. So helping to empower you with that knowledge will definitely help you succeed. So these are the key reports that you'll see, and we'll go through each one and understand what they tell you. I'll work through an example to show you some key learnings and things you can look out for, and we'll use a made-up company, Foods Co, for the examples. For those reports: trading account, profit and loss and balance sheet, statement of changes in equity, depreciation, scheduling, shareholder current account. So trading account attracts your sales, your variable costs, and your gross profit to calculate the return you're achieving before deducting your overheads. Gross profit percentage indicates whether your margins are improving or deteriorating. So that is such a key indicator for most businesses, some more relevant than others. But you can track your results across different divisions or product lines by having different trading accounts. Say you had distribution in the South Island and the North Island, you could track both and see which was trading better. Or you had multiple locations around the Bay of Plenty, different stores or something like that. You could track each division on its own and ideally identify issues quicker. And small adjustments in your trading account can have massive impact on your overall results, which I'll demonstrate right now. Hopefully I get my click in the right place. So this is an example of a food manufacturing company's trading account. So as you can see, they had sales of just over $1 million, cost of sales of $318,000, giving them a gross surplus from trading of $700,000. This should be in your workbook as well. So if you need to sort of work through the numbers later, that'll be there. Direct costs were just over $450,000. Gross surplus was $248,749, and a gross profit percentage of 24%. So the gross profit percentage is the gross surplus divided by the total sales. Let's just say the company does some coaching with their accountant, implement some strategies to increase their customer retention rate, resulting in 10% increase in sales. Wouldn't we all love to see that? They also work with their accountant to review their inventory processes, reduce their cost of sales by 5%. They renegotiate the contract with their delivery provider, which gives them a 5% saving in their direct costs. And as a result of these changes, their gross surplus has increased by $140,000, and their gross profit percentage from 24% to 35%. So you can see that on $1 million, another $100,000 is not necessarily massive. It may only be some small tweaks depending on the number of customers you have. And just understanding these numbers and how small adjustments can make a massive difference. Here's one more click. 2 more clicks. Okay, so onto the profit and loss, may also be known as the income statement. It shows all your earnings and costs over the year and tracks the overall performance of your business. matches your income and expenses over a period with adjustments for timing differences. So if you've made a sale but you haven't received the money for it, that may be included in that period, but it won't, so you haven't seen the cash for it. And that's why it's important to remember that the profit and loss is not the same as cash. Profit is not cash. The profit shown in your profit and loss, or P&L, has non-cash expenses in it, such as depreciation. A loss on sale of vehicles is not necessarily cash. Loss on sale of assets, things like that, are non-cash items. So that's why it's important to make sure you still have sufficient cash to cover things such as loan, principal, repayments, asset purchases, drawings, things like that. Profit and loss provides a framework to benchmark the results by using percentages or comparisons between years to compare your business performance to similar businesses. Obviously, it's often tricky to get access to any similar businesses information, especially in the small business space. But as accountants, we obviously have access to a lot of different businesses. So it's having the profit and loss and being able to compare that to other similar businesses can definitely help you understand where you are, where you sit in the market. And a lot of people don't realize this, but your business is generally valued using a multiplier of your earnings. So your profit and loss statement is a massive driver of the value of your business. So that's when you come to sell it. Obviously, the higher your earnings, the higher your value. So it may be that in your industry, the value of a business is 3 times your net profit. So if you're making $100,000 a year profit, then your business is worth $300,000 plus assets and things like that. But you see, if your business is worth $120,000, then your business is worth $360,000. So you can see how small adjustments in your profit can make a massive difference when you come to sell. So this is our Foods Co again, profit and loss statement. So it's the same company. So we've taken the gross surplus from the trading account, and then all of the expenses, the overhead expenses are listed underneath. And then the owner's remuneration sits at the bottom there. As you can see, the company is currently trading a loss, $113,000. So let's say the company does a review of all their expenses, identifies potential savings to be made with insurances and rent, contact an insurance broker and their landlord and negotiate a 5% reduction for both expenses. So they've saved $597 in insurance and just under $3,000 in rent. However, you'll notice that the accounting fees have gone up because they worked with their accountant earlier on to increase their gross margin, increase their sales, etc. So that obviously goes the opposite direction. So despite the increase in their accounting fees, though, their net surplus has gone up by $138,000. So often the gains to be made are above this line, above this account, above the expenses line in the trading account, depending on the business you're in. So yeah, that's a massive jump there. So hopefully I'm not going too fast for anyone. Cool. So the balance sheet, also known as a statement of financial position, names are interchangeable. So that provides a snapshot of your business's financial position at a specific point in time. So the trading account and the profit and loss, they cover a set period of time. So it could be 2 months, it could be 6 months, or generally when you're doing, say, your annual accounts, it'll be over 12 months. But the balance sheet is the snapshot point in time. So that's could be at the end of a month or at the end of a financial year. And it could have changed 2 days before or 3 days before, or what have you. So that's why it's a snapshot. It measures the net worth of your business, which is your assets less your liabilities. It shows if your business is solvent. So that means if your liabilities are greater than your assets, then the business is insolvent, and you need to take pretty urgent action to fix that. Companies office is obviously not a fan of businesses trading insolvent, so you got to be very careful trading insolvent. You're basically breaching your director duties if you're trading insolvent, so you need to be quite careful if that's the case, and you need to fix it pretty quickly if you can. So you can compare different periods to determine whether the business's net worth is increasing or decreasing. So that's just the snapshot, at the end of every month, at the end of every annual financial statement period. You're looking at whether that's going up or down. So the stronger your balance sheet, the easier it will be for your business to survive the downturn. So a strong balance sheet has solid assets, a higher level of assets versus liabilities. It also gives you the basis to calculate some key ratios, such as your debtor days and your inventory days. I'll talk through those next. So, as you can see, this company is currently insolvent. This is our Foods Co again, as it has more liabilities than assets. It's the 305,000 basically. Yep. Oh yeah. It's also got no working capital, which means that its current assets of 138,000 are less than its current liabilities of 162. That means if all of their liabilities here, if all of the people that they owed all this money to, all of a sudden went pay us back today, they wouldn't be able to realise that cash. Even if they sold off all their inventories for exactly the value that they need to, got in all their debtors and then their cash, they wouldn't be able to pay off those debts. So that working capital is important as well. So it's that current stuff, that short-term stuff. So the business ideally needs an injection of funds, so of at least 305,000, and that obviously you don't want to increase your liabilities, so that can't really be in the form of a loan. That would need to be in the form of a share capital or shareholder loan. Putting that in there. I know the shareholder loan sort of sits in here, but generally the shareholder is going to be the last to get paid if something goes pear-shaped. So often when I do my accounts, I tend to put the shareholders' advance accounts into equity because it's kind of the same sort of thing. But yeah, even if we move that into equity, we're still going to be 285,000 short. So over the long term, the company could implement some strategies to reduce their debtor days and inventory days. So to calculate your debtor days, it's dividing debtors, which we've got here at 72,000, by sales times 365. So in this case, it gives us a number of days of 26. That means it's currently taking average 26 days for the company to get paid when they issue an invoice. So if they updated their terms of trade and requested payment within 7 days, and they're not going to bring that straight back down from 27 to 7. So even if they brought that down by, say, 5 days, that would free up $13,000 of cash. Just give them a bit more, because obviously cash is the most liquid asset you can have. You can just pull it out of the bank at any point in time. Trade and receivables and inventories are less liquid because you need to either sell inventory or you need to chase debtors and get them to pay you. So that's why reducing those debtor days means the cash is in your pocket much sooner. So that means they have that extra $14,000 available. So also, so this is these kind of strategies and things are important to look at if you are having cash flow problems. Like you may have plenty of sales, but if your customers aren't paying you, what's the point? I guess you want the cash in your pocket, so that's where that's so important. So inventory days is similar sort of calculation. So you're dividing your inventories by your cost of sales. So slightly different, but cost of sales rather than debtors, rather than sales. And 365. So that tells you how long the inventory is sitting with you before it's sold. So 74. So obviously if you're in a food type of business, you'd want that to be quite light because food goes off and then you have wastage and things. Some businesses may be longer. These probably industry sort of averages for lots of types of businesses. But 74 days is a lot of time. It basically means you've paid for that inventory and had it sitting in your store or wherever for 74 days. And that cash has been tied up in that inventory for 74 days. So if they reviewed and updated their inventory processes, this also applies to work in progress. So if you're a service-based industry and you are doing work and basically capturing the cost of that work, but maybe not billing for it. So say say in my industry, I would potentially prepare accounts and do work for clients. And if I'm sitting on that and not billing it, or if it's taking me 6 months to finish the job and not bill it, then that's my work in progress at that point. And basically it means I'm not getting paid for that work for months. So that's how it can sort of be applied to a service-based industry. So if they change their processes, or revamp their website so things were more appealing, or adjusted the types of products that they were having, identify which products were not slow moving, got rid of those, all sorts of strategies you could implement to improve it. So if they improved it by, say, 9 days, that would give them another $7,860 in their bank. So while this is not, it doesn't fix the solvency issue because it basically moves the asset, I guess, from inventories and receivables into cash. It does help with cash flow. So statement of changes in equity, it shows what happens to your profits. So they could be paid out as dividends or kept in the business as retained earnings. And that's a strategy that is unique per business, depending on what the business is trying to do as to whether you pay it out or you retain it. It represents the net worth or value of the company and is an indication of the company's sort of financial health. It shows whether the company's solvent. So obviously this one isn't. And what needs to be done to sort it. It's kind of an indicator of what needs to be done to sort it out. Cool. It's also where gains on assets would go, like capital gains. So like if you were to sell a building or something like that, that's where it would be reflected. These are the companies that accumulated losses for at least the last 3 years. We are opening balance of negative 139. Company has no retained earnings, definitely insolvent. No money to pay out as dividends, no money to reinvest in the company to purchase new assets. Obviously, directors need to do something pretty quickly to increase the profitability of the company. Cool. Shareholder current account. So it's a record of all the funds introduced to the business by the shareholders or taken out as drawings. Can help you monitor your personal spending made from the business. And with more than one shareholder, it helps to maintain what the company owes to each, or what's been withdrawn. If your account is overdrawn, that means the shareholder's taken too much, and that's generally been funded by some other external fund or the other shareholder, so it's important to keep track of it. And if it is overdrawn, basically that shareholder will have to pay interest to the company, which creates more taxable income in the company, and is not ideal at the IRD rate. So it can be quite pricey. So they put the account back into the positive balance. The shareholder can either repay the loan, company can increase its profit to pay a salary, or you could do a dividend. But it's quite important to try and keep that in the positive. So obviously you have to talk to your accountant pretty quick, smart if you notice your shareholder current account become drawn. It may be that the shareholder salary, the profit for the year will cover it, and it's fine to go into overdraft during the year. And then we allocate the salary at the end of the year. But it's important to keep on top of that and know what's going on. So the shareholder current account shows that at the start of the period, the company owed the sole shareholder, Mr. Doe, 29,000. He's introduced 2,000 to the company. Some of these things may be year-end adjustments as well that your accountants process. So it may, if you are unsure what the numbers represent, then have a chat to you. So he's taken over 9,000 out of the company insurance and life insurance. He pays his life insurance through the company, but that's not a company expense, so it becomes drawings. So that means at the end of that financial year, the company owes him 21,000, just under 22. Cool. So the amount owed by the company to Mr. Doe, it can obviously only be repaid. The company's solvent and has the cash available to make the payments. At the moment, we know that it's not, so there's no cash there to pay him out that amount. So he would need to introduce the money to bring the company back into solvency so that we can ideally trade profitably. So I guess to ensure that this company is able to pay those funds out to Mr. Doe, we would need to implement some strategies to increase that profitability, which could be the things that we discussed when we were looking through the trading account. That would give us profit of that 20 odd K for this year, improvement of 138, and help to dig out of that insolvency problem. And obviously it's not sustainable to keep introducing money for a business that's not profitable. So cool. And the fixed asset register or depreciation schedule could be called either one. It records a business's fixed assets, like vehicles, plant and equipment, computers, office equipment, etc. And I guess facilitates or demonstrates or shows, whichever word fits, the spread of the cost of that asset over the useful life. So if, just to take a step back, for an asset to be classified as an asset is the IRD threshold's $1,000, excluding GST, and it has to be it's something that's going to be used in the business for a period of time. So a vehicle, obviously, you're not going to just use it for a year and then dump it. You're going to either sell it on or you're going to keep using it. A computer is generally going to last hopefully more than a year. Phones, things like that are over $1,000. We have to spread the cost of that asset over the useful life of it. And generally the useful life has kind of been determined by the IRD. It's not really worth doing your own because then you've got to do tax adjustments. So most accountants will just use the IRD rates to determine what the useful life of that asset is, so we can spread the cost. It's the basis for keeping track of the business assets. And it can be useful to let you know when assets, how long you've had assets for, and when they know I need to be replaced. And it also records them for when you come to sell a business. You've obviously got a record of what assets would go with the business, or what assets you may keep, what would go, etc. So say you had a laptop and you're like, well, I won't have a laptop if I sell the business, so I'll keep that. You pull it out of the asset register when you come to sell, take the value out. Cool. So the first column in the asset register is the names of all the assets. So that's what's important whenever your accountant says, what was this you bought? You know, what's this $1,500 that you've just written computer? But you've already got 4 computers on your asset register. And we kind of go, can you give us a bit more detail? Because if we put computer on the asset register and then one of them breaks down, we're never going to know which one it is and never going to know which one to write off. So that's why your asset register ideally would have the detail of what that asset is. And most accounting software also has the ability to record serial numbers, things like that. So if you want to get a bit more detailed, say you've got an office with 10 computers, you may want to record serial numbers or something like that to, when one breaks down or needs to be replaced, know which one to replace and pull out of the asset register. So, and the cost, obviously, that's the GST exclusive cost of the asset. Next column is the opening value of the asset at the start of the financial year. So this is the costs less the previous depreciation. Depreciation is just another word for the portion that we've written off, that we've said that the value of the asset is reduced by that amount last year. The next 2 columns are purchases and disposals for the year. So what's new? What have we got rid of? Go, oh, yep, no, that computer's got to go, or you know, we've replaced that signage or whatever, or we've sold that vehicle. That's recorded in here. Or it may be just, oh, I don't have that anymore. We threw it out during the year, or I don't know what that is. Have you ever had that? I've definitely had that a few times. Like, pretty sure we don't have that particular, you know, bookcase or whatever. We just get rid of it because you see it's not an asset of the business anymore. The next 2 columns show the depreciation rate. You know, as I said before, that's generally going to be from the IRD. They kind of have a massive list of depreciation rates that they sort of have put out, and it's for smaller businesses, it's just to use those. And diminishing value, that DV, that's a method of depreciation. So it means that we get to claim that percentage every year. It means that the amount that you claim each year on each asset decreases, but you get the bigger claim in the early years. So end result is the same, but we just means we get to claim it sooner, claim the bigger amount sooner. Oh, and then we've got the depreciation for the period. So if you would take, say for that top one, 7,846 times 30%, that would be 2,354. So that's our cost that we can claim for this year on our profit and loss. And then you've got the closing accumulated depreciation. So that's the total claim that we've made on that asset over the life that we've, over the time that we've had it. And then your closing value. So that's the end of year value. And that's what sits on your balance sheet. So that's kind of the 6 key reports that you would look at regularly. The balance sheet, the depreciation schedule is probably a little bit trickier because you have to know how to run depreciation to get a value of that during the year. So that may be just a once a year thing. But the other ones, ideally, you'd be looking at them regularly. And I guess each report tells a different story about your business and helps you make decisions depending on what each one says. I guess if you have any questions, chuck them in the chat. I'll answer them at the end. in the meantime, we'll just have a quick chat about the difference between profit and cash. Okay, this is a common thing. So turnover is vanity, profit is sanity, cash flow is reality. It's common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. And it's so important to understand the difference between profit and cash, and why a high profit doesn't necessarily result in more cash in the bank account. So a profitable business can go out of business because it's starved of cash, and a business running at a loss can survive because it has access to funds from investors or financiers or whatever. So in other words, cash flow is every business's reality, and it is cash is king. It's kind of in business or in life, really, cash is king, but in business especially. So to demonstrate the difference between profit and cash, these are some items that might affect it. So GST, it affects your cash balance, but not your profit. So we chuck it over there. Loan repayments, they affect your cash balance, but not your profit. Interest on the loan, that will affect both profit and cash. So we pop that in both. An asset purchase, so that's those ones that are over $1,000. That obviously affects your cash, but not your profit until we start to do the depreciation. Asset sales, so that's the same, cash. And then the depreciation is the asset related, I guess, line that affects your profit. So as you can see, even if you've got a healthy profit, if you're making loan repayments and buying assets, then you may have no cash, basically. Another one that may impact your profit but not your cash is drawings. So if you're taking out too much personal cash out of the business, that can affect your cash flow. That clarifies a little bit for the slide. I think the slide in the workbook is kind of a bit funny because this is animated slide, it prints out kind of funny. Cool. So the business 101 cycle is, I guess, another useful way to demonstrate the difference between profit and cash. So in a business, first the owners need to invest in the business. Not many businesses that can start up from absolutely zero. So you use this, so you invest the money into the business, use this money to generate income, so to buy assets, to implement things that will make the business go. So the business may need additional funding that may come in the form of a loan to finance those purchases. And the assets are then used to generate profit, which is giving you a return on your assets. You can increase your profit by profit gains, sales growth, margin growth, some of those things we talked about before. But then there's some other things that can drain your profit. So unchecked overhead expenses, things like that. The profit then ideally gets turned into cash, which is from your business activity. There are some drains on cash, obviously, which we just sort of spoke about. So slow collection of debtors, increase in stock or work in progress, business loan repayments, tax payments, or fast payment of suppliers. So if you're paying your suppliers before their due dates, then you may want to pull that back. There's no need for the money to be in their account rather than your account any sooner. And obviously there's some gains on cash, which is faster collection of your debtors, decreases in stock and work in progress, basically the opposite of the other ones, slower payment of your suppliers, and reduce your tax. So all these things that your accountant can ideally help you identify and improve. And then we go back into the start of the cycle. So then the owners can take the drawings, cash for their own use, or personal loan repayment. So I guess The aim, I guess, of this is to go through the cycle as quickly as possible. And that increases your return on investment. So the quicker you can use your assets to generate profit and then generate cash, the quicker you get that cycle spinning, and the more profitable and the more value in your business. Cool. Hopefully that makes sense. Yeah, so accelerate the spin cycle. Cool. So after your cash flow, which is your day-to-day business, I guess, indicator, the business value is the next most important measure of your success. And idea, especially if you're coming to a point where you're looking to sell, getting that value and that spending that time to get these things tidy 2, 3, 5 years before you're going to sell will definitely help you maximize your value. So I guess part of knowing your numbers is understanding and measuring the drivers of your business value. So that might be your monthly recurring revenue, your revenue growth, revenue per client, sales, profit, different for every business, but working with your accountant to identify the drivers of your business value will definitely help increase that value and give you more for your next adventure, whatever that may be. Cool. So enhance the value of your business. Ideally, a plan will be in place with enough time to actually implement the plan. And having things like your organisation structure, roles, etc., documented. Having things nice and tidy will help improve the value. Cloud-based real-time reporting, so using things like Xero, helps you make more real-time informed decisions. Reviewing, documenting your systems and your processes. And not only will it help when you come to sell, it will also help you identify inefficiencies that you may come across while you're doing that process. And helps you make sure everything's running, smoothly. It reduces and help putting in place processes to reduce the reliance on yourself as the owner will help enhance the value because it'll make it much easier for someone else to take over. And that could be documenting things, making sure everything's nice and tidy, and reducing that reliance on you. That also helps with you being able to take time off and things like that. And identifying and managing risks is also a key value driver because it means you can fix them before they become a bigger problem. Cool. So some steps to protecting your assets. Profitability, cash flow, and the value of the business will all affect you personally because it's the value of the business is what you can sell it for. Profitability is what you can take out, drawings, things like that. So you obviously want to fund the lifestyle that you're in business for. So there's a few other things you can do to help protect your assets, which I'll quickly run through. So set up your business ideally as a company. So you've got that limitation of liability, helps protect your personal assets. Consider who should be the director of the company and which assets are held personally by directors. So remembering that if something were to go wrong in your business and someone were to come after the business assets, or something that had happened in terms of liability, the director can be found personally liable. So if you've got, say, a husband and wife team or something or a partnership of some sort, you may want to think of whether you both want to be directors or not, just because that exposes more of your personal assets. So it's important to think through these things when you're initially setting up. And you can always change them as well. So consider make sure you have any security over any loan you lend to others. Not major, but not a major thing that happens, but just, something to be aware of. Consider alternative ownership for high value assets. So say if you had a commercial property, you may want to have the ownership of that property in a separate legal entity, so another company or trust, and pay a rent across between the two entities. That just means if something goes wrong with the trading entity, then the other entity that holds the property is secure. Things like that. Review your terms of trade, credit policies, to make sure you're reviewing customers to ensure that you're only working for people that are going to pay you. Review your insurances, make sure you have sufficient protection. Do you have business interruption, indemnity, public liability, and enough cover to ensure the impact on your business is minimal. So that's just having an awesome broker and chatting to them about how you operate, what you need, personal access to personal funds, things like that. So financial planning, obviously that helps manage your personal wealth outside of your business, keeping that safe and secure and working for you. Plenty of awesome people out there that can help with that. And finally, plan for the future. So that just comes down to having your will up to date, your powers of attorney, your memorandum of wishes if you have a trust, and a clear plan of how to transfer your wealth to the next generation, if there's any left. I know that my parents definitely adhere to the ski policy of retirement, which is spend the kids' inheritance, and they've earned it, so they have every right to spend it. So that's totally up to you, but just making sure everything is documented if something goes wrong before you have a chance to do that. So obviously this isn't an exhaustive list, and it depends on your business and your personal circumstances, but there's a few other ways that you can sort of protect your assets, business and personal. So we can dig a bit deeper if we need to, on your specific circumstance. Cool. So how does it all come together as, I guess, best practice? So I've got the 3 essential tools for business growth, business success. Is a business plan. So what are you going to do over the next 12 months? A budget forecast. How does that translate into dollars? And are we going to make sure that the business is making enough money for you to have the lifestyle you want? And that ongoing reporting and accountability. So the reporting makes sure that you're tracking against the numbers you want to achieve, and you're measuring things. And the accountability coaching. The accountability is coaching, which is basically having someone regularly touch base, be like, hey, how are you going? What did you do what you said you were going to do? If not, why not? Let's set some goals. Let's set some more actions that you're going to do to really get your business in tip-top shape. So knowing your numbers, I guess, is just the beginning, but it really does help you understand where your business is going, what it's worth, why you've got no money, no cash in your bank, what decisions you should make going forward. So where to from here? Obviously, it's a tricky time at the moment, so everybody's sort of trying to do what they can to maximise their business and ensure that they survive. So I guess what my aim is to help you take what you've learned today and implement some positive change in your business. So it's time for you to decide what you're going to do. So take a few minutes after the webinar to write down your 3 actions or projects that will add value to your business. So I will ask for these in the little feedback questionnaire that I send out later this afternoon. So have a think about what you want to do to move the needle in your business and get it really humming. Identify the problems that you're facing, and just sort of have a think about how you can fix them. Take the moment to work on your business, not just in it. I guess doing nothing right now is not really an option because you'll just go backwards. Cool. So I guess now you've got the best practice tools. This is what we can do to help, I guess. If you don't currently have a business plan, we can help you development one. That's sort of a one-page active document, 1 to 2 pages active document that helps you set the plan for the year. Budget, cash flow, forecast. So that's the plan for the 12 months and where your money's going to come from, where it's going to go, to make sure you're actually getting what you want out of it. The coaching is the regular accountability piece. So that's catching up regularly, generally once a quarter, to go over what's going on in the business, any burning issues, and set some new actions and review the ones from the last time. Management reporting, that will give you an insight into what's going on in your business, what's happened over the last couple of months. And obviously those early indicators will give you much more power to change things quicker before you end up too far in the hole. And we do have complimentary meetings for new clients, and occasionally for existing clients, depending on where they're at in their business and whether we've done one recently or not. Obviously it's tricky at the moment to commit to spending any money. All of these services include an assessment as to how you can improve your profitability and cash flow. So the aim of all of these is to ensure that you are coming out better off. So your return on investment, ideally, is about 4 times what the cost is. Sorry if I'm a bit wobbly, but earthworks happening and it makes my whole office wobble. And we can spread all those costs over a period if you need to. So I guess just obviously the information in this webinar is pretty generic, and you can't substitute it for one-on-one advice looking at your specific numbers. So one-on-one, obviously, we can make the biggest difference. So let me stop my screen sharing. And over there. I'm just going to have a look through the questions now. There's one here from Tony, who I believe has had to pop out. But I'll send her the recording so she can get an answer. What happens when the asset is valued at 0? Get rid of it / replace it if the business can afford. So generally, if an asset's written down to 0, it will be down. Will it probably be like 50 cents or something silly like that underneath the threshold. If it's still active, keep using it. That's fine. It's not really major. It just means the full value of that asset has been claimed over the time. If you were to sell that asset and make it for something, you would create a small taxable profit. And if it's sitting there, it's still active, then we just leave it there. And then when it gets thrown out, we just write it off, and there's no impact on the profit and loss, basically. Cool. And I've got a couple of questions here that I have sort of brainstormed before. And I sort of was like, a lot of people don't know what the difference is between the annual accounts and the accounts that you can generate yourself. So generally that's going to be the year-end type adjustments. So depreciation, tax, potentially splitting interest and principal on loans if that's not being done on a regular basis, prepayments and other sort of adjustments that we have to make for the IRD, basically. So the biggest difference is that the annual accounts are generally pretty historical, whereas your regular management and court accounts are much more up to date. The other thing that may be a difference is, unless you're doing a regular stock take, if you are a stock-based business, maybe that, if you've got inventory, maybe that we're not able to get a super accurate trading account, just because otherwise you'd have to do a full stock take, whereas the annual accounts ideally would have a full closing stock value in it. Another one's quite a common one. What's the difference between markup and margin? So are they the same? Yes and no, kind of. The markup in dollar terms is the same as the margin, and that both are the difference between the cost and the selling price. But in terms of percentages, say you had an item, you bought it for 75, you sold it for 25, the markup and the margin of that of dollar terms, sorry, you bought it for 75, sold it for 100, is $25. It's the same. But in terms of percentages, markup and margin are not quite the same. For example, if you buy that stock for $75, sell it for 100, your markup is 33%, which is 100 divided by 75. So you're taking the costs and adding 33%. Whereas the margin is 25%, which is the difference between the two, taking from the top number down. Hopefully that makes sense. Any other questions before we wrap it up? No, I will let's go back to the slideshow. Cool. I just want to say thank you everyone for attending. Hopefully you got some value out of it. I will send out the questionnaire, a little survey later this afternoon. Really appreciate if you could fill that out. If you want to chat about any of the services, if you're not a client and you'd like an initial meeting and a catch up, just indicate that in the survey and we'll be in touch. Otherwise, have an amazing day, and yeah, go forth and enjoy your business. Have a great weekend. Yeah, thank you very much.